Hello everyone. So in today's session, we're going to talk about equity markets, and to do that, we have Mr. Sailesh Bhan, a Deputy CIO at Reliance Nippon Life Asset Management. From Jan 2018 onwards, so we're talking about more than 1.5 years now, and during this period, while Nifty and Sensex have been up by about 5-6%, the broader market, BSE 500 is down by about 5%. BSE mid cap is down by about 25%, small cap is down by about 40%. So naturally, all the investments that we people have made over the last year in whatever format, lump sum, SIP, all of them are in the red. So Sailesh, my first question to you is, when are we going to get respite?
See, markets have their own cycles. They don't necessarily exactly move on a calendar basis, right? And like you mentioned, most of the damage has been in specific pockets, whether it is small and mid cap companies. And primarily that damage is coming from a very high base of 17. So some of the problems are more a function of sell-offs happening in specific categories of stocks where there was over ownership by a segment of the investors, which is creating prices for you. So somebody looking at an SIP, especially who has an horizon of 5 years or 10 years, actually gets to average out a lot more and actually enables him to have a larger part of his total investment at reasonable rational prices. The other aspects, for example, within large caps also, there are opportunities which are there where valuations there also have corrected in certain pockets, and in some pockets have remained above 5-7 year averages, right? So if you go through it, this correction is actually created sensible prices. Like in 2017, every stock in India had a story, right? And that was also wrong effectively, where valuations were being at a much higher level, especially in the mid and small cap businesses. Now, virtually after 24 months, with a new government in place, with a rational runway in terms of growth available to investors to participate in, with certainty of growth and a majority government, right? You have an opportunity to capitalize on this, right? And these corrections only allow you to get business in good prices. Like they say, you either get good news or you get good prices. So when you are getting good prices, you will not get good news. In 2017, you are only getting good news, right? So I think it's the context of that you have to see. Right. And if you are not over allocated to any one segment of the market, right? Though it's not been a great phase in the last 12-15 months, like you mentioned, but I think that becomes a very good starting point and very good point to increase specific allocation to equities, and don't let the allocations fall when the markets actually correct. So it's actually you behave pro-cyclical. You should not behave pro-cyclical but counter-cyclical to how the markets are behaving.
Sure. Today when you pick up the newspaper or listen to TV, there's no dearth of negative news. So everything, whether it is to do with the global growth slowing down or the trade war related news, on the domestic front as well, so much negativity in terms of our own growth, kind of coming down, auto segment having its own problem, liquidity crunch in NBFCs, and whole lot of these things. So how do you assess the market conditions now, within all of these things? What are the positives that you see, and what could possibly trigger markets, from here on?
If you just sub-segment and see the market, right, only a very small percentage of the market is at a much higher level. But I would presume or guesstimate is maybe 70-80% of the market is actually at 3-year lows, right? And in this kind of a scenario, it only means that prices are in your favor. Now, I understand that prices will be in your favor if there is some economic bad news, if there is some challenge on the global front, right? 2 years back, these were positive, so you had much better prices, right? So I think you're getting prices. The key thing, let us take one sector, for example, if you have an auto sector in mind. Auto sector, there was nothing could go wrong virtually 2 or 3 years back, where leaders were priced at 30-40 multiple, right? And now when they have corrected 40-50%, and obviously they correct for a reason, which is lack of credit in the system in the interim. But I believe this situation is temporary. It cannot be that lack of credit in India will be there for maybe a 12-month or a 24-month period from on. So I think a lot of these are transient. Because they are transient, they are giving you an opportunity. And India being so under-levered in terms of retail credit is the potential which you really can capture. So you have to see today, instead of seeing what's being reported today, think about what newspapers will write 12 months out. If you think 12 months out, you will still have negative news flows, maybe the market can trend lower. But rationally, 12 months out, newspapers will write positive things, and by that point of time, a lot of things might be in prices.
Right.
So I think directionally, it's more a rolling outlook of how you can see things change over the next 12, 18 months. I, for one reason, cannot believe that credit in India will not start picking up even 12 months out, because we think this is significantly got to do with what was happening in the non-banking finance company space. And I think with some stoppage there and some challenges getting over, I think credit will only improve from here on.
Right. Sailesh, you handle two large funds and very successful funds, the Reliance Large Cap Fund and Reliance Multi Cap Funds, amongst few other funds as well that you handle. Now I'm going to ask you a binary question. Right? Large Cap obviously has a mandate to invest at least 80% into large caps, the top 100 stocks, as per regulations. Whereas multi-cap has a diverse mandate, and typically your multi-cap, we understand, invest about 40 to 60% into large cap and the remaining into mid and small cap. So between the two, if you were to advise investors based on the current market context, what would you, I don't want you to give an answer saying that a little bit in large cap, a little bit in multi. Between the two, if you were to pick one, what would your advice be at this context?
I'll answer it in a binary manner only. See, if you want to choose, you have 3-year money, you choose Reliance Multi-Cap.
Okay.
Because large cap has already, as a category, done very well in the last 3-4 years versus where the mid and small cap prices are there. Second point I just wanted to answer, there is always this point that large cap means it is saturated or it is large enough and all that. See, the large cap includes companies with market caps of $3 billion to $100 billion.
Right.
So some company which was $3 billion also became $100 billion in India, right?
Right.
So I think the journey for large cap means companies who know what they are doing in most cases. So these are established businesses with a lot of capability. So large cap also has its own opportunity, and within your allocation you can choose whatever percentage you want to own. But large cap doesn't mean they'll grow below the market or lower than the market, right? The biggest demonstration of that was visible to you in the last 2 years, right, where everything else collapsed and this segment of the investing actually did very, very well. Coming to the multi-cap, there are two aspects to that. The why multi-cap should be a true multi-cap product which has both large and mid-cap at different points of time is a function of where valuations in each of these categories are. So when you have a valuation differential, if you remember in 2017, the valuation differentials were too much in favor of large caps, right? Whereas mid-caps were actually overvalued, right? You've seen the shift happen. So as a portfolio manager, we can actually manage to move 8%, 10%, 15% of the portfolios to specific companies in the mid cap side or the small cap side which we want to own for a period of time. We have been doing this gradually, right? So that creates an opportunity for the portfolio to capture any shifts in valuations in those areas. It is not because the valuations have come off is that what we have done. We have done it because of those companies themselves have a strong runway of growth and now are at rational prices. Okay. So we are not buying inferior companies which have become cheap in the sell-off. So our focus is to buy good businesses which have 10-15 year runway even in the mid-size categories, plus they have a valuation in their favor versus where they have been in the last 5 years and where the broader markets have been trading at.
And in terms of themes of sector, what are those themes and sectors that you're overweight on or you're more favorable investing into right now?
See, primarily the themes and sectors which we are focused on are all significantly domestic because we think whatever has happened in the last 3-4 years in India, driven by the government reforms, whether it is event of demon or GST and all that, has actually compressed growth. Plus, if you see many sectors, a lot of profits of those sectors are at 8-year, 10-year lows or 5-year, 7-year lows depending on the sector, whether it's auto, whether it's engineering, whether it is corporate banks and all that. And we see that already shifting. For example, we have seen corporate banks already delivering much better earnings on an average than what it was even 2 years back or 1.5 years back. Right. We think this shift is reasonably secular and can last for 3, 4, 5 years. So we think domestic oriented companies where valuations are rational, especially in these categories, have a significantly long runway. And given that you have the advantage of buying them at reasonable valuations, even if there are some disappointments, the impact is much, much lesser.
Sure.
So you end up owning right set of businesses over the next 3 years which can have earnings way better than index earnings, and you still have the participation in the same indices. Sure. So I think the function is domestic oriented, domestic cyclicals which today are under stress, which all the newspapers talk about are actually opportunities for the next 3 to 5 years in India.
Sure, sure. So Sailesh, thank you very much. Would you like to kind of give a closing remark, possibly for a minute or 2 minutes, kind of summing up whatever we've been discussing over the last 20 minutes about the outlook for the market, which parts of the markets to invest into in terms of market cap as well as sector themes?
See, as we discussed, the most important thing in the markets is not to look at today's news and take a decision. You have to actually try to see what can happen 12 months, 18 months out, right? For the last 15, 20 years, India has been asking for a single government mandate.
Right.
When it has come, you're looking at some other variable. So idea is, are those critical 4-5 things which you want: a reasonable interest rate environment, a single majority government, right? Second generation reforms. You have already taken the pain of GST and you've taken the impact of IBC, right?
Right.
All that has happened. And now you're getting better prices after all that.
Right.
So there are no questions to be asked. Just have a 3-year rolling view and have a participation into this.
Great.
So if you look at today's news flow and do investing, like events like China has depreciated the currency or US-China trade wars, yes, they can create some kind of sharp changes in the markets, which like you alluded to at the start. But if you are allocated sensibly and you are participating in this at this point of time, overall rewards over a 2-3 year period should actually be in favor of investors than being there. So there is no point in reading today's newspaper because the whole world is reading that and acting.
Right.
The idea is to can you read what can be written 12 months, 18 months out, and can you own those businesses which will benefit out of that. So there is value lying in good companies, whether there is large, mid or small, and that's the beauty of the markets.
Great. Wonderful. Thank you very much. We hope that you liked this session. We'll keep coming back to you every month. Thank you very much once again.
Thank you very much.